Hello, welcome to the fifth module of the Advanced Taxation class. And today we'll be looking at capital gain tax and education tax, capital gain tax and education tax. And we'll look into calculation of chargeable gain and losses, determination of cost, proceeds, and indexation, exemption under CGT, the education tax base, and computation under the Third Fund Act. And we look at the filing and remittance procedure. Briefly, this is going to be briefly. And when we talk about the capital gain tax, tax on the profits gain made from disposing of chargeable assets. And the backing of governing law is the Capital Gain Tax Act, CAP C1 LFN 2004. And the key principle is it's an event-driven tax. It's an event-driven tax triggered only upon disposal. It's an event-driven tax triggered only upon disposal, sales, gifts, exchange, in whatever way it comes. And the tax rate is actually a flat 10% on the chargeable gain for all taxpayers, which is individuals and company. And the scope of it is that it applies to gains on assets situated in Nigeria and assets abroad owned by Nigerian residents. And when we talk about the disposal, it actually includes sales, gifts, transfer for less than market value, or exchange of assets. This is disposal. These are the disposal of assets, means of disposal of assets, and then the market value substitution rule comes in, and then this talks about if not sold at arm's length, or example as a gift, the market value at disposal date is used to as the proceed, and the core component of the calculation is one, the disposal proceed, and this is what you receive, or the market value. And another is the incidental cost. The incidental cost. And when we talk about the incidental cost on disposal, it's the cost to sell, which is talking about the agent fee, the legal fee, and we also have the allowable cost, which is the cost to buy and improve. And the example of this is cost. It's a cost to buy. An example of this is the purchase price, the legal fee on acquisition, and the enhancement cost. In doing this, we have in computing the chargeable gain, we have the format here, which is disposal proceeds minus or less the incidental cost of disposal, which results in net disposal proceeds, and you also less the allowable cost, which is in acquisition plus enhancement. And at this, you'll be able to get the chargeable gain. And capital gain tax is actually 10%, and then it will be the 10% of the chargeable gain, then to be able to get the capital gain tax. And if the result is a loss, it is an allowable loss, and this will be carried forward indefinitely to offset future capital gains. And we have inflation relief, which is the indexation allowance. And the purpose of this is to adjust the acquisition cost for inflation. So it can be taxed on real gain, not on nominal ones. And how it works is that the allowable cost is multiplied by a factor based on the change in the retail price index, and from acquisition to disposal. And the index cost is actually original cost multiplied by the RPI at disposal, divided by the RPI at acquisition. And the application is that it typically applied to assets held long term, like shares, and each capital expenditure is indexed from its own date. We also have capital allowance under the profits, under the capital gain tax. We have the common exemptions. These are the common exemptions from the CGT, the common exemptions from the CGT. And when we talk about this, not all disposals are taxable, and you need to keep, there are key exemptions which include principal private residences, government securities, motor vehicles, life insurance policy and pension rights, compensation for personal injury, and corporate reorganization. These are common exemptions from the CGT. They are common exemptions from the CGT. And looking at the education tax, it's actually a 2% levy on the accessible profit of companies in Nigeria. And the purpose of this is to fund the tertiary education trust fund for educational infrastructure and development. And a guiding or governing law for this is the Education Tax Act and then the Tax Fund Act 2011. And the taxable person are all companies registered in Nigeria, individuals or partnership are exempted. Individuals or partnership are exempt from it, and in calculating this, the tax base, which is accessible profit, it is the exact same profit calculated for company income tax. And just like I said, the tax rate is 2%. And to calculate this, we have it as shown. You add back disallowable expenses to the accounting profit before tax, and you less the allowable deductions, and you are able to get the accessible profit. And then after the accessible profit, you calculate the 2% of the accessible profit to be able to get the education tax. And then the key relationship with the company income tax is that the education tax is 2% plus CIT, 30% is equal to effective total tax rate of 32% for profitable companies. So that brings a relationship between them, the addition of the education tax and the company income tax rate, which brings about 32%, from the effective tax rate of for the profitable company. And in computing it, we have a scenario: profits before tax of 150 million, and you have to add back just like we said here, you had back the disallowable expenses, depreciations and co, and then you less the allowable deductions. You less the allowable deductions, and as such, we are able to get the accessible profit. And when we talk about that, we have 160 million as accessible profit, and we charge a 2% on the 160 million, which is the 3.2 million. It is 3.2 million, which is the education tax that has been deducted. And in treatment of losses, we have for capital gain tax, losses are treated as allowable losses, can be carried forward indefinitely to be set against future capital gain and cannot be set off against other income. And for education tax, if a company has and has no accessible profit, which is tax loss, its EDT liability is nil, and the loss is carried forward per CIT rule. And as per the compliance and penalties, the CGT, the filing deadline is 30 days from disposal, and the payment deadline is 30 days from disposal of the demand. And the key penalty is actually an initial penalty plus monthly penalty plus interest on late payments. And for the education tax, the filing date is 6 months after year end, and payment deadline is 60 days from filing, and or 60 months after year end. And the penalty is 25,000 for the first month plus 5,000 per month after plus interest. And There is need to maintain all records, the acquisition cost, the disposal agreement, the tax computation for at least 6 years to be able to do this. And in conclusion, CGT is a 10% tax on gain from disposal of chargeable assets, and also the use of indexation allowance to adjust for inflation on long-run assets is being looked at. Then we also saw that the education tax is a 2% levy on a compelling accessible profit, funding education via debt fund. And we've seen that education tax and the income tax act, compelling income tax are computed on the same profit base, and compliance is critical for both tax to avoid significant penalties and interest. And having understanding of these two is essential for effective corporate tax planning and compliance in Nigeria. Thank you.